Hello and welcome to another edition of our Personal Finance and Wealth Building series on Business Edge. Many people want to grow their wealth, but often assume the stock market is only for the wealthy or financial experts. The reality is that anyone can invest in the stock market with the right knowledge, discipline, and long-term strategy. Today, we'll demystify the stock market, explain how it works, discuss the risks and rewards, and help you understand how to start investing wisely. Whether you're a first-time investor or looking to build a stronger portfolio, this conversation will equip you with practical insights to make informed investment decisions. Chinazom Izuora, investment broker, Parthian Securities Limited, joins me for more on this. Thank you for joining us today.
Thank you for having me.
Now, what does someone need to start investing in the stock market?
So the first thing you need to start investing in the stock market is a brokerage account. So when we say a brokerage account, it typically means you have to open an account with a company that is registered with the Securities and Exchange Commission as a broker-dealer or a brokerage firm. And when you register with them, they'll collect your KYC, they'll create a CSS account for you, and then they most times give you access to the trading engine. As the market is developing, a lot of brokers are now adopting new technology. So brokers now have online platforms, mobile platforms, and the traditional way is to call your broker, send your broker an email, and place a buy or sell mandate.
All right, that's interesting. So how much does one need to start investing in the stock market?
So companies have different policies, but ideally, you can actually start investing in the stock market with any amount. I actually believe it's one of the investment avenues that has the lowest barriers to entry. Because when it comes to the stock market, the smallest amount of any stock you can buy is 1 unit. And we currently have stocks on the Nigerian exchange that are below 5 naira. We have under 10 naira stocks. We have some stocks that are 100 naira. I
think below 1 naira?
Yes, we do. So you can actually start with any amount. So it's one of the lowest entry markets.
That's interesting. So talk to us. I'd like us to look at some of the things one has to consider before choosing to invest in a particular stock.
Okay. So I always believe that before you decide to invest, you start with your investment objectives. What am I trying to achieve? So this money that I'm setting aside, what is it that I'm setting this money aside for? So ideally, we tell people that investing in stocks or the equity market is a medium to long-term investment. Because of the nature of the equities market, it's not where you put money you need for short-term things. So, for example, you need to pay school fees, you need to pay your rent, you have short-term commitments. That's not where you put, it's not equities you put that kind of money in, because the equities market by its nature is volatile. There's a lot of fluctuations in prices. So first of all, the money you're putting in equities should be designated for investing in the medium to long term. It's money that you can afford to put to work and not be calling intermittently, because the market does move. It's volatile. A share price is one thing today, is another thing tomorrow, and then you don't have that kind of control. So first of all, what's my objective? Am I investing for long term, medium term? What do I care about? Do I care about dividends, which is getting periodic income from this investment, or do I just care about capital appreciation? And then, of course, we also have emerging fields. We have people that now invest for the good of it, for supporting growth companies, supporting companies that are doing things they agree with, which are the ethical investors. So people come to the market for a multitude of reasons, but getting value out of investing in the market is basically doing what's consistent with your own objective.
All right, that's interesting. We understand that, before you can put your money in a particular stock, we need to be sure that the stock is doing well. Even if you're already in the market, you need to also check. So what are the things we should look out for when you're looking at a financial statement or financial result of a particular company?
Okay, so I think it's important to realize that when you're investing in equities, you're becoming a shareholder of a company. So you're becoming part owner. And so think of it like your business. If you are looking at your own business and thinking, is my business doing well, what would you be looking at? Profitability, efficiency, management, the operations of the company. So those are the type of things you'll be looking at. So the same thing, when you look at a company's balance sheet, Warren Buffett always says, buy what you know. So if you invest in companies and industries, you understand their business, it's a lot easier for you to do this. For instance, you know how banks make their money. They lend people money, they charge interest. So because you know how that company does business or what their business is, if you look at their balance sheet or their financials, you can immediately tell, is this company doing well? Are they profitable? If a company is a consumer goods company, you know that they manufacture things and they sell those things. You can now think to yourself, when I go to the supermarket, do I see this company's product on the shelf? Do I buy it? Do people I know buy it? Do people like it? Because those are the things that will tell you if this company is likely to make money and continue making money. And those are the things you need to pay attention to when you're choosing companies to invest in. Because you're basically giving this company money. You're giving this company your money to run their business, and you expect a return. So they need to be profitable.
Absolutely. Let's talk about profit taking. Is it meant for everybody? Because when you take profits, doesn't that reduce your stake or your share in a particular company? How do you do it?
I think that's actually very interesting, and it's something that people need to understand. When we say profit taking in the equities market, it means you're selling. You're closing your position, you're selling. Because with equities, it's not like a fixed income investment that you can say, pay me the interest, and my capital is still there. When you take profit in equities, you're selling part of your investment. So you don't just take out the profit. Typically, what you do is perhaps you bought 5,000 units. You bought the 5,000 units at 20 naira, the share is now 40 naira. So you want to take profit means you might sell 2,000 units. You may sell 10,000, 1,000 units. So taking profit in the equities market is that you're selling to crystallize that gain. Because for equity market, the gains are mark to market. So they're not, accountants will say it's an accounting profit. It's not cash in hand. It's just that the price of this has gone up since you bought it. So for you to actually cash it, you need to sell. So when people say they are taking profit, it means they are selling, which is why you will hear analysts talk about how the market is down because of profit taking. What they're essentially saying is that people bought this share when it was low. Now that the price has gone up, they are selling to take their money out. That's how it works.
All right, must everyone take profit?
So no, everybody mustn't, and it depends on what your investment is. So there are a lot of investors in this market, and I think it might be good to make it clear that there are different types of investors in the market. You have speculators, which are like traders. They just want to make quick cash. So traders have a short-term horizon. They are here to grow their capital. So they start with 5,000, they want to be at 15,000 at the end of the week. So they buy and sell, and they take profits aggressively. Then you have people that are long-term investors. They are just buying every opportunity and building their nest egg towards retirement. You have a lot of those investors that they don't sell. They are very happy to collect their dividends. So we have a number of those. And then we have people that are medium term. And then we have one of the things that is critical in Nigeria's market now, we have institutional investors. We have asset managers, we have fund managers that have the fiduciary responsibility to invest people's money. And because it's a fiduciary responsibility, they are not speculating. They are buying fundamentally sound companies, they are holding it long term, they are rebalancing their portfolio and doing what is consistent with the investment objective they've communicated with their customers. So there are different players in the market. Each player behaves differently, and each player impacts the market differently.
Okay, so that means before I start investing, I need to be clear on the kind of investor I am.
Who do you want to be in the market? Do you want to be part of the problem or part of the solution?
Who are the problems?
Well, it depends on who you're speaking to. But yes, basically, you have to decide. And especially young people, you know, they say younger people have a longer horizon, so they can be more risk. They can take more risk because they are younger. And the older you get, the less risk you can take, right? Because you're closer to retirement, you're not working actively. So you might see younger people trading actively. If they take a loss, it won't make or break them. Sometimes the amounts they're also trading are not that large, so the losses are not going to be that significant. For people that are closer to retirement, you might see them buying fundamentally sound dividend-paying companies, and they're very happy to just receive their dividends. If they now need cash for an emergency, they will look at their portfolio and sell what is in market to free cash, but they are not speculating as much as traders and more aggressive investors.
I have like 3 questions. I don't know how to merge them into one because my producer says I should stop. So, can an investor completely avoid a bull market? And then maybe we should just end it there. Yeah.
Okay, so
A bull trap. Yeah.
a bull trap is basically like when you buy something because the price is going up and you believe, oh, we're entering a bull market, so it's a good time to enter. And then that doesn't happen. It's possible because, like we said, equity market prices are volatile. I think the best way to avoid buying high, basically, the best way to avoid buying high and not getting stuck is to stick to your investment objective. Decide what you're going to do. So if you say that, oh, I'm going to buy and sell if I get 5% or 10%, then do that and don't get greedy. Because sometimes people get stuck in these positions because they've said, oh, I bought this thing at this price, I'm going to take profit at this price. Then it gets to that price and they think it can go another 10, 20%, and then it doesn't happen. So sometimes you get lucky, but be clear on your investment objective, decide exactly what you're doing, how you're doing it, leverage technology, and then do what you intend to do.
All right, that's quite interesting. I like what you said. I mean, that great part, yeah? And so you said you're going to sell at 20, and before you knew it, maybe in 2 days from 10 naira, it has moved to 20 naira.
Then you want to wait.
Let's wait a bit. It might move to 50 naira, and then you're stuck at the end of the day. Well, she already told you how to avoid bull traps, so try not to fall into that particular. Maybe we'll still have some other conversations on stock because there's a lot to talk about, but we just have to end it here. Thank you so much.